Jeremy LEFUFU smells like pee-pee. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon! And we're going to talk about this interesting video that I found called Jeremy's PE ratio. Apparently, Jeremy, the genius investor, has created his own price-to-earnings ratio. But before that, he's going to show us what a PE ratio actually is. And I want you to pay close attention. So let's watch part of this video.
Group and whatnot. I don't think I've ever done a video where I really talk into depth about the Jeremy P ratio, and how to calculate and whatnot. I talk about it in my book a bit. I talk about it in the stock market investment.
And apparently he does have a book. It's like $100 or something. You should buy it, bro. It's a good deal.
Investing mastery course I have, but I don't think I've ever done a specific video kind of going into depth on why I do it this way and kind of the differences between calculating a regular current PE ratio or a forward PE ratio in my way and why I do it that way. And I might be the only one that does it like this. I don't know. It's I haven't really seen anybody else use it like this. I think maybe Warren Buffett does it the same way. I do not know because I don't talk to Warren Buffett.
I mean, me and Warren Buffett are on the same intellectual and investing level. So, of course, my PE ratio, nobody else uses that except maybe Warren Buffett. It's a secret nobody on Wall Street knows, except for LEFUFU.
I don't know exactly what he's doing, but I think he calculates companies' value the same way I do, and it's a very important thing. Is, in my opinion, as far as valuing stocks, this is right up there at the top, and why I do it, guys. So, Jeremy's PE. So let's talk first about what's a current PE, okay? A current PE, and how do you calculate that? A current PE basically means usually they're going to look at the last trailing 12 months. So the last 12 months of earnings per share, okay, otherwise known as EPS, the last 12 months of earnings per share divided out by whatever that company's stock price is, okay? Whatever the stock price is, and that will give you, your current PE ratio, okay?
Price. Okay, look at PE. It's P/E. Price divided by earnings. What does LEFUFU have here? Earnings divided by price. So if you use this, you would basically have a insanely low PE ratio, and you think every stock you're looking at is cheap. This is like an earnings yield ratio. He completely flip-flopped it. What a moron.
The earnings per share divided out by the stock price. Another way you could calculate it, which will get you the same exact number, would be net income divided by market capitalization, okay?
Market cap divided by net income. Not net income divided by market cap.
Income divided by market capitalization, it'll get you the same exact number as if you take the EPS and divide it by the stock price, all right?
Can you believe this guy has the audacity to charge you $2,500 every 2 years? And he can't even get the freaking PE ratio right? And didn't this go through review? Did somebody look at this and say, hey, Jeremy, you actually flip-flopped that? And if you realize that, okay, maybe he had a brain fart. Shouldn't you fix this? This is pretty freaking bad.
Current PE. The other one that I really love to use a lot, if I'm just talking about it in videos and whatnot, and for simple sake, is what I call the forward PE, which is basically the forward PE is when you're kind of looking at what the company might earn in the next 12 months. So what they're expected.
So you're just pulling crap out of your butt, basically.
To earn, I guess we'll call it expected, divided out by, this is expected EPS over the next 12 months, okay? And you're dividing that over by the stock price, all right? And like I said, with this one, you can do it the same way as far as the expected net income over the next 12 months divided out by the market capitalization currently, and that will get you.
Oh, Jeremy, you make this so easy. Woo! Now let's go look at Jeremy's PE. So apparently, this is the true PE ratio, earnings divided by stock price. Now let's go look at Jeremy's PE, which nobody has ever used this to calculate stock valuations before. Never.
Process of it. Then we'll do an actual example, and I'll use numbers and whatnot, and we can kind of calculate things out. So I do use the cash plus the investments, and then from those numbers, I subtract the debts, okay? The debts from that company. So that could be short-term debt, that could be long-term debt, whatever's on that balance sheet for debt-related things, I'm going to subtract it from these numbers, all right? So then I'm going to get, X. I'm going to get my X there, whichever number, we got there. So what I do after that, I've got this number, okay? So then I will add or subtract X from the market capitalization of that company, okay? So we're going to do an example here. I'm going to add or subtract to the market capitalization, and basically that is dependent upon if this is a positive number, okay? If this is a positive number, if there are more cash and investments than debts, then I'm going to subtract that from the market capitalization. I'm going to bring that number down, okay? Why am I going to bring that number down? Well, because this is more money than they have in debts, okay? And it basically brings down the PE ratio in a real way. Now, if they have more debt.
Okay, so he's basically calculating net debt, and he has cash plus investments. Are those short-term investments? Are those marketable securities? Because companies have all different kinds of investments. They have held-to-maturity investments. They have, short-term investments, trading securities, available for sale securities. There's a lot that goes into investments. But basically, he's just calculating net debt. All you have to do is say, okay, if I bought this company now, how much basically cash would I get free and clear? Now, the other issue with this is there's a difference between book value and fair value. For example, if you have a held-to-maturity security, that's not trading at fair value. That's trading at the amortized cost. So when you're looking at a balance sheet, when you actually value a balance sheet and you try to calculate the true value of it, let's say you're looking at property, plant, and equipment or whatever. That property, plant, and equipment could be worth a ton of money on the market. But you have accounting, and in accounting, you don't write up property, plant, and equipment based on increases in fair market value. It's a conservative principle. You depreciate it, and it's shown at its cost net of depreciation. So what he's doing here is just this very weird, net debt calculation. Of course, people factor this in. And the market cap of the company probably already reflects this because other analysts are looking at it and they say, oh, yeah, I know about the net debt, calculating net debt. I did this in Finance 101. I'm going to factor this in to my freaking stock valuation. Yo, but only Jeremy does this, bro. But he actually gets the PE right on this one.
Then they do cash and investments. Then I'm going to add whatever that difference is there. I'm going to add that number actually to the market capitalization, which will increase the price, okay? So basically, I get my number X, and then what I'm going to do is I'm going to either add it or I will subtract it from the market cap, okay? From the market cap. And don't worry, we're going to do a full example here, and we'll kind of break it all down and whatnot. So I'm adding or subtracting it from the market cap, and it's all dependent upon if there are more cash and investments than debts, or there are more debts than cash and investments, all right? So now I get my new number, my new market cap, let's call it, okay? New market cap. And I want to make sure I usually work pretty fast in videos, so I'm going to really try to take my time with this one and make sure you guys get it. So now
he knows this so well. You just take cash and investments, bro. I mean, what type of investments? And then you just subtract debts. That's it, bro.
I have my new market cap number, my new true market cap number. Now, what we can go ahead and do, we can figure out, we can calculate things based upon either what the company earned in the last 12 months, what their current PE ratio is, or what their net income was last year, or we can go ahead and try to, calculate it out and try to figure out what we believe that company will earn over the next year. So we can do it either way. We can figure out current or forward. So let's just say, we'll just go on a current basis. So whatever that company earned in their last year. So I'll go ahead and take that new market cap and we'll divide that out by the net income that company had last year, okay? Net income that company had last year, and then that will equal Jeremy's PE, okay? That will equal my PE there.
Oh, now he gets the PE right. Good job, buddy. We're really proud of you. This guy is such a freaking joke.
All right, so let's recap this, and then we're going to go over an actual example, and we'll break all this down. So you're taking your cash and investments, which is a balance sheet item, okay? And I'll get into why it's important in just a second. I'm taking my cash and investments, which is a balance sheet item, and I'm subtracting the debts from that number, okay? Which is also a balance sheet number. Then whatever number I get here, I'm going to get my X number, okay? I'm going to add it. I'm going to add to the market cap if there are more debts than cash and investments. I'm going to subtract the X number if there's more cash and investments than debts, okay? Then I get my new market cap number, which is like the Jeremy's market cap number, we can call it, okay? Divide that out by the net income, and I'm going to get Jeremy.
Nobody else has done it but Jeremy.
Jeremy's PE ratio, okay? I'm going to get Jeremy's PE. So now let's take it through an actual example here. We can just leave all this stuff up here. I'll do a difference, all right? So right here, 5 plus 5 equals basically of $45, all right? We get all that so far. Let's just go over one more time. $5 in cash they had, $5 in investments. That equals $10. Then they had $5 in debt, so we got to subtract these two numbers. We get plus.
And you can see it's like he laid it out so poorly. Like he could have said, okay, cash plus investments minus debts equals, net debt, basically. But how he laid it out, if you follow his format, you take the $5 and you subtract out the $50 market cap, you have a negative market cap of 45. Like, this is so poorly put together. If you're going to develop a course like this, what are you doing, dude? I mean, at least take a little bit of time to actually format your freaking crap correctly. This is a joke. So the guy does no editing. He just half-asses his whole freaking course. He can't even really tell you what a price to earnings ratio is. It's a joke. But there's a lot more gold, trust me. So tune in. I'm going to keep going over some of these videos, and I hope you guys enjoy. Cheers!